Well, meantime, the oil surge contributing to stagflation concerns for our next guest. Let's bring in Subadra Rajappa, head of research at Societe Generale. Subadra, great to see you.
Great to see you, too.
So stagflation, how much of a risk is it right now?
The market's starting to look towards that risk. I mean, typically, we've never had kind of a stagflationary episode. For the first time in a while, we're starting to look towards that. To me, in line with what you guys were discussing earlier, the front end of the Treasury curve feels a little bit unhinged. I was not expecting the two-year yield to climb to 375. The market's not pricing in any more cuts for this year. This was something that happened overseas. We saw this happen with the ECB as well as some other countries where the market started to look towards pricing in hikes. But now we're not pricing in any more cuts for this year.
Stagflation risk would imply that you think that this is not just an inflation spike, but that this is going to be a longer-lasting inflation period. Is that correct?
Yes. You're talking about sticky inflation, perhaps even higher inflation. And what that does, especially in an environment like this, what you're going to see is the consumer is going to come under pressure because of higher oil prices. Disposable income is going to decline. That's going to have an impact on growth. We typically look at the U.S. and say, you know what, we're an oil producer. There's, the oil companies are going to benefit from higher oil prices, but it's also going to be a tax on consumers.
But the argument against that, we've been hearing people come left and right saying it's only 1.8% of consumer spending. This is not your daddy's oil crisis, your grandfather's oil crisis, because we're so much less reliant on oil these days in our daily life. How do you counter that then?
Well, like I said, it's a disposable income, and we're at a point where the savings rate's very, very low. So there's just not much room for the consumers to really maneuver out here. And you have a dicey job market where hiring has really been flat. You're looking at the pace of job creation is slowing quite dramatically, and there aren't that many job openings. So it is kind of a moderating employment outlook. I think investors in general, consumers are very cautious, and this is going to be an additional burden.
Subadra, we talk about every new Fed chair is challenged by the market. And Kevin Warsh, again, if it is Kevin in May, is walking into an employment picture that's deteriorating, an inflation picture that seemingly it continues to be a problem. And he has a president that today, I think, and you and Mike were talking about it, was talking about Jerome Powell yet again, time to lower rates. So that's a bit of a buzzsaw that he's walking into.
Yeah, and he's going to be in a tough situation in the fact that he has to convince the entire committee to get on board with cuts. The whole premise for his pitch for lower cuts was, cuts was the fact that productivity would go up. You'd have this AI boom that would lead to lower inflation. That would give the Fed room to cut rates. This is a completely different scenario that came out of nowhere that nobody really had in their bingo card. I must say, we typically look at a different set of scenarios for how the economy is going to play out. Stagflation was not one of those scenarios.